Hi, everyone, and thanks for joining us today. I'm Jonathan Pompan, a partner here at Venable, where I focus on regulatory strategy and compliance across consumer financial services ecosystem, working with banks, fintechs, investors, and platforms, lead generators, marketers, advertisers, and the like, navigating the evolving state and federal legal landscape. Today's session, Deregulation Nation, from Oversight to Opportunity in a Shifting Financial Services Landscape, is going to focus on the evolution of from oversight to opportunity. It's going to be a conversation looking at how the ground has shifted, not necessarily the laws themselves, but the infrastructure around them, the regulators, the examiners, the priorities, the pressure points, and the risk. It's a different world than even a year ago, and it calls for different thinking. Before we begin, the usual disclaimer: the program today is for general informational purposes only and does not constitute legal advice. While we'll share practical insights from our work advising financial services clients, specific legal decisions should always be made in consultation with counsel, and today's session is not reflective of an opinion of any one of our clients or position in any particular engagement. Now, today's session is also for CLE. And today's session is going to include two CLE code opportunities where we'll be providing you the information specific to the CLE registration process. Please also know that at the conclusion of this webinar later this week, you'll receive an email and information about CLE. If you're attending during the live session, you'll automatically receive one of those emails from Venable, and therefore do not need to reach out to us. We'll send that to you once we have everything prepared and the sessions available for downloading on our website, venable.com. If you have a question, please feel free to use the chat feature. We'll try to get to those during the session, but if not, please understand that we will try to endeavor to get back to you after today's session in the next day or so. And we appreciate your feedback as well and your attendance. So thank you very much. And with that, let's get into today's session. So here's how we're going to spend our time together. We're going to start by setting the scene and framing what's actually changed. And many of you have been following along probably in great detail, that's really the nature of all of our jobs. So what hasn't changed and what has changed is really going to be the focus here. And we're going to focus on federal oversight, but just a little bit of understanding of where the state stuff comes in, because that's really a big portion of the story. And today, I'm pleased to share the stage and this webinar with two of my partners and colleagues, Michael Bresnick, former Department of Justice, and now litigator and regulatory attorney. Mike.
Hey, everybody. It's nice to see you. I'll be talking in a few minutes after Jonathan.
And my partner, Chris Boone, who's an AI, crypto, stablecoin, digital payments guru, and the intersection of the regulatory landscape with payments and digital currency and the existing framework is a big portion of his practice. Chris?
Thanks, Jonathan. Happy to be here.
Thank you, Chris. And as I mentioned, folks, we're going to also talk a bit about some spotlights with payments and cryptocurrency. But if you have questions, please feel free to chime in. We'll try to work those in and as best we can. And for more on these topics, please be sure to check out venable.com. And if you're looking at this and viewing this in audio or video through YouTube or other social media sources, please feel free to like, subscribe, smash the bell for announcements. The Venable team is doing a lot of different webinars this summer on various deregulation topics, and many of which are cross-cutting and some of which may be of interest to you. So let's start here. And, the regulatory outlook, managing compliance during change is a challenging one. Every day seems like there's new developments, but the trend line is clear. Things are changing. And, they say a picture is worth 1,000 words. And I think the important thing to realize is that in some cases, the picture is even probably worth more than 1,000 words. It may be worth several multiples of that. And for those of you who have been following along with the Consumer Financial Protection Bureau, this picture here says a lot. The reality is that the sign's gone on the CFPB, and it's been gone for quite some time. The enforcement agenda has stalled. Supervision is essentially paused. And while the Bureau technically still exists, it's no longer defining the regulatory environment the way it once did. But the important thing is that the laws have not changed. UDAP, unfair, deceptive, abusive acts or practices under the Consumer Financial Protection Act, is still a statute that is up and enforceable, not just by the CFPB, but also the states. The Fair Credit Reporting Act, Electronic Funds Transfer Act, Truth in Lending Act, Fair Debt Collection Practices Act, all the alphabet soup of the consumer federal financial laws are still live. But what's changed, though, is how these laws are interpreted, enforced, and prioritized. And that's what we're here to unpack. What do the legal and compliance teams do in the absence of this guidance and the regulatory structure that's been built up over the last 12 to 14 years? And what fills the federal vacuum when there's, where is the opportunities, but also where are the risks in the months ahead, in the years ahead?
Jonathan, if I could interject, is the CFPB really dead, or is this more like a headline and political theater? What's going on?
Yeah, Chris, I think, what's important to know, of course, is that the Bureau is technically not dead. There is no shortage of newspaper articles day in and day out that talk about various aspects of the potential future of the CFPB. The important thing to realize is it does still exist on paper, and there's a whole timeline that's been unfolding around that, particularly around litigation about the future of employment relationships with the CFPB staff. But that's really just on paper. The statutes it enforces are still on the books, and that's really important to keep in mind. And there's a few interesting areas where it's still active in some segments of the financial services industry, and certain very few pieces of litigation that the CFPB was active in before the Trump administration took over. And some of that may have some broader implications for certain sectors or certain areas, and certainly the consumers involved. But functionally, the CFPB is largely dormant. The acting director has gutted staffing, told them all to stay home for the most part, rescinded nearly all of the Chopra era guidance that was pushing the boundaries, and signaled that most supervision and enforcement are no longer priorities. Now, we'll touch on what is, at least on paper, priorities for the CFPB in a moment. But just a few weeks ago, there was the resignation of the acting head of enforcement, and that wasn't just symbolic. That was someone who had worked at the Bureau from the inception, had also worked at the FTC, so had worked under multiple administrations. And it really confirmed what I think many people in the sector and financial services world already knew, which is that in very many respects, the CFPB is not going to be active with respect to a lot of enforcement in the coming months and years. So the issue isn't whether the CFPB still exists, it's that it's no longer playing its former role. There's going to be a vacuum, and that vacuum is what matters because it creates uncertainty for institutions that have built compliance systems around federal expectations. The idea that the CFPB might come knocking and routinely examine on a periodic basis. And so, things aren't necessarily going to be as predictable as they had been.
Hey, Jonathan, we've heard a lot about efforts to defund the CFPB, especially from consumer groups. What do you make of those comments?
Well, certainly the budget bill that just passed and was signed by President Trump cuts CFPB funding essentially in half, I think to about 6.5% from what was like a 12% number of Federal Reserve funds. So it's a fair question. And look, some of the language being used is pretty dramatic, and the funding changes sound dramatic too. But the reality is that many of the complaints amount to trying to stop the defunding of what's already functionally dormant. In some cases, some people might say it's even a bit of a corpse. The reality is that the CFPB staff had been effectively hollowed out since the administration took over, and with enforcement being stalled, the guidance being rescinded, and staff have either been sidelined or have left the building, so to speak, with more possibly to come. That's a reference to the disputes over whether or not the Bureau staff can be fired or if they have to be kept on. But nonetheless, they're not really being asked to do much, certainly not what they were being asked to do previously. So you can't really defund something that's really not doing much or anything. So some of it's semantical, Mike. For the little it wants to do, there's going to be some money available, and there's going to be staff available. So, I think from a legal or business standpoint, the interesting question, and frankly, the more urgent conversation to be had, is what fills that vacuum. For companies trying to operate in good faith, there's a real uncertainty, but I think that's so much of what everybody's been focusing on is not on the death of the agency, but on what it means to navigate the landscape without it. And there's some important steps that I think companies should be taking to document and essentially be their own self-regulator. And that still means engaging legal departments, compliance staff, outside counsel when necessary, and understanding what the legal obligations are, even if there isn't an active bureau breathing down their throat.
So we've seen this CFPB's new priorities memo, but should companies treat this as a real shift in policy or just politics in memo form?
It's a good question. In April, the CFPB put out a priorities memo that was obtained by the Wall Street Journal and published and written about quite broadly. When we wrote about it and commented on it, we called it a real shift. And frankly, it's one of the clearest signs yet that the CFPB, as we know it or had known it, is not just on pause, but it's being intentionally redirected. The memo outlines a plan for the CFPB that would still have it be operating, but certainly at a very different pace, velocity, and scope than it had before. It'd be much narrower in focus, just focusing on its statutory enforcement mechanisms, but also probably a subset of that. And I think it's really too soon at this point to know what or how much of everything that's in the priorities memo will come to fruition. It's only been a couple months, and certainly the bureaus and the plans there are still evolving. So, how that translates into actual supervisory or enforcement activity, that remains to be seen. But at the same time, it does signal that things like debt collection, truth in lending, Fair Credit Reporting Act, EFTA, remain areas for potential federal scrutiny, and same with mortgage. And companies should not assume that deregulation, or in this case, sort of deprioritization, equals essentially de-risking, particularly with the states able to step in with perceived regulatory gaps. And, the strategic moment at this point, I think, is for companies to use this opportunity. Maybe it's an opportunity to catch a breath, to review compliance programs, especially to the extent they're operating on a 50-state basis, on a state-by-state basis, and in alignment with federal law, and ensure that their core practices align with the current federal and emerging state expectations, while also being mindful of the potential for future regulatory snapback. At the same time, I think the memo does present a refocus and reprioritization, and presents an opportunity for companies to, if not, push the envelope with respect to legal compliance, use it as an opportunity to build and consider new products and services that maybe heretofore they had viewed as being stifled by the prior administration. So it doesn't mean companies are off the hook, but it means that they no longer know exactly where the hook is. And within that framework, legal risk and due diligence has to be done carefully.
So, Jonathan, the CFPB recently withdrew 67 policy statements, interpretive rules, and advisory opinions. What do you make of that?
Well, it was a lot. And, I think that's exactly the point of the new administration and where we're at. Many of those documents, though, I think importantly to understand, were never binding. In fact, most of them, if not all of them, had language to that effect embedded in them. But they shape behavior anyways. They were intended to be the interpretation of existing consumer financial law, but in some cases, pushed the envelope. And whether it was compliance officers baking them into risk programs, possibly for good reasons because of the risk and the importance of being aligned with expectations, regulators referencing them in exams, and that included just state level exams and investigations, or courts and even investors in some cases in M&A situations, citing them as evidence of industry standards or best practices. That guidance had real world impact. And with the mass withdrawal of these 67 guidance documents and the halo effect that it had, the current management of the Bureau is signaling a shift, a return to statutory and formal rulemaking, with more informal interpretations being cast aside. So no longer is there really a blur between the lines of what is a suggestion or an obligation. But at the same time, that does create a vacuum. And I think the important thing is not to mistake the withdrawal here from a change in actual law. The reality is that the underlying laws are still in place. And many of the statutes have private rights of action. Some can be enforced by state enforcement mechanisms and state analogs. So if anything, companies now need to reevaluate past decisions. Maybe some stuff can be done that maybe they thought hadn't been able to be done because of the sub-regulatory guidance. But I think it's important to still align with black letter law. And of course, also take into account now that in this post-Chevron world, there's no longer a one-stop regulatory shop for interpretation, whether one liked it or not. So I think the message means that compliance teams, in-house legal, need to be documenting what they're relying on, the reasons for why, and then ensuring that it still reflects current enforceable law. And I think the role of advising on that, as well as defending it if it becomes an issue, remains as important as always.
So if the CFPB is not active, who is filling the gap? I've been hearing, and I believe you've been writing some about California and New York and some active AGs, but are states really stepping into this void, or is that overstated?
Yeah, Chris, first, you're exactly right. And if a company is the target of an inquiry by California, New York, and other states, whether it be AGs or regulatory agencies, it's true. States are still playing an active role. I think they're stepping up, certainly in rhetoric, if not in practice. It may not be every company that gets contacted by them, and certainly, hopefully, if they are, it's for legitimate, reasons. But it's as meaningful as ever. And any company that's under investigation or any type of scrutiny would say it's painful. So now the difference is perhaps there's less coordination. In some cases, there had been some coordination that was happening with, between federal and state regulators that's now just on the state level. And in California, New York, and some others are definitely picking up the pace. And, DFPI is active in California. DFS is active and has been saying they're going to become, even more active, looking for more staff and looking for ways to fill the gap. And even New York, in New York, the state AG, Letitia James, has been pushing the Assembly and legislature for even broader UDAP authority. And California is always expanding its scope of supervision programs and has been quite active in that over the course of several years. Outside of those states, there's certainly other vocal state AGs and regulatory agencies, and that patchwork of licensing and whatnot hasn't changed at all. And if anything, it just makes compliance, I think, harder, not easier, because for institutions operating across the states, it means, now more than ever, a 51 state compliance strategy. The same thing would mean for potential investors in fintech and other consumer financial services companies. It also means the legal risks may be more acute and less predictable. So I think they are stepping up, Chris, but the inconsistency is probably going to be the story over the next several years.
Hey, Jonathan, what do you recommend legal and compliance teams do now?
Well, we know that the laws haven't changed on the federal level and the regulations haven't either. So I think with the laws not having changed, the important thing is to realize that perhaps some of the referees have. So that means that the statutes that are still in place are still the law. The Consumer Financial Protection Act still prohibits UDAP. The Fair Credit Reporting Act still governs credit reporting. EFTA still covers unauthorized transactions and a lot of different electronic payments. But how those laws are interpreted, enforced, and prioritized, and the other laws that make up the consumer financial alphabet soup, I think is going to become a lot more fluid. For legal and compliance teams, I think the moment calls for some discipline, documentation of interpretations, updating risk assessments, creating audit trails, showing good faith compliance. All of this sort of, to the extent that anybody would say it's a regulatory vacuum, still creates the need for the continued involvement by legal and regulatory compliance, because that's going to be the protection for the company. It will need to be self-driven, but without clear examination and in some cases guidance that may or may not have been helpful, companies and the legal and compliance departments are going to have to think like their own regulators. At the same time, it also opens up the potential for opportunity. And because if something also I think is important here is that if something were to go sideways, folks may be judged retrospectively. And so when there's the potential for snapback, the ability to be able to show the work and why a particular act or practice or product was compliant will be as important as ever.
Well, so with regards to the FTC, with no supervision authority, is the FTC a real threat, or is it more of a headline generator?
Mike, you want to weigh in on that?
Yeah, I mean, so in contrary to the CFPB, the FTC is alive and well, and in fact, it seems to be thriving. There's been no significant doging of the commission. There are no attacks on it by Congress. Maybe could you go to the next slide, Jonathan? There was a concern, or at least a question, sort of a few months ago, when you see these are the current commissioners, and you got the three Republicans up top, Holyoke, Meador, and the chairman, Ferguson. But President Trump fired the two Democratic commissioners, Bedoya and Slaughter. And, there was a question at the time of what is the sort of, what's the continuing nature of the FTC going to be? Is it going to be, is this just the beginning of the gutting of the commission or not? The answer is no, it's not. And I'll get to that in just a second. With respect to Humphrey's executor, it's a Supreme Court case that's going on now. Humphrey's executor was a 1935 Supreme Court opinion, in which Congress's ability to limit the president's removal authority of certain independent agencies was challenged. Humphrey himself was an FTC commissioner. He was fired by FDR, and poor Humphrey died before he could see his case through the Supreme Court. But his executor on his behalf challenged it, saying that the president was only allowed to fire him and remove him and other commissioners for cause. And the Supreme Court agreed and said, yeah, that the president's removal authority is limited with respect to these independent agencies. That ruling has been somewhat limited over time, especially with the Saylor law opinion with the CFPB a few years ago. But now making its way in the Supreme Court is a case Trump versus Wilcox, in which President Trump had fired a member of the NLRB as well as the Merit Systems Protection Board. And they're challenging the president's ability to fire them without cause. And there's a question of whether Humphrey's executor is going to survive or not. But that's the fact is, we'll see. So we'll see about that. But right now, if you can go to the next slide, Jonathan, even with these three commissioners, you see the FTC is still, like I said, actively investigating payments companies and others. Just last month, just a few weeks ago, in fact, it filed a $5 million settlement for unfair payment processing practices by Paddle. Paddle is a UK-based company that facilitated, according to the FTC, deceptive tech support schemes. I'm going to get in a little more detail into this case when we get into the industry spotlight. I'll be focusing on payments, and I'm going to talk about this case before Chris gets into crypto specifically. But what I thought was interesting about this case in the announcement, Chairman Ferguson said, and that's here on the screen, but it's worth stating, today's settlement is an important win for American families and businesses. Myopically focusing on individual foreign scams could drain the Commission's resources while hardly making a dent in their onslaught on American consumers. But by vigorously enforcing our laws in our payment systems, the Commission ensures that private industry takes the steps the law requires to protect Americans from foreigners who would use a payment system to prey on them. And you see the bullet point there, the similarities to Operation Choke Point. And so just a little bit of background about me. Jonathan mentioned I was at the Department of Justice. I was there for 10 years, including at the end, the last two, as executive director of the Financial Fraud Enforcement Task Force. And in that role, I was one of the creators and founders of Operation Choke Point. And I can tell you that this is exactly the point we were making. The idea about myopically focusing on individual scams is not a good use of our resources, our time, or efforts, or energy, or anything. But you want to focus on the bottleneck of where the problem was. And Chairman Ferguson says it well here that by vigorously focusing our enforcement on the payment systems, we're going to make sure that we're going to protect Americans from foreigners, in this case, who would use a payment system to prey on them. So it's a question of what the FTC is certainly focused on payments companies. I know there are currently investigations that are still ongoing, and so we'll see how they continue. But any thought that the FTC was going to follow the route of the CFPB can be completely dispelled, certainly by this action, in which, by the way, it was a 3-0 commissioner vote, the three Republicans, because they're the only commissioners on the FTC at the moment. So they all voted for this complaint.
Yeah, Mike, the one thing I'd add there too is I think, whether it's consumer financial services lead generators or non-bank consumer financial services companies, the work that the FTC has done over the years in the consumer financial services space has transcended administrations, not just like the FTC Act, but the telemarketing sales rule, TSR, ROSCA, all sorts of different statutory authorities that the Commission has. And if we look back on the prior Trump administration and go further back, it's Democrat or Republican, the FTC has been active, and that was before the CFPB and at this point after some of the activity of the CFPB.
Right. And let's see, can you move on to the next slide?
Yeah, at this point, we'll just give the CLE code for those needing CLE. The code is going to be Oversight 2025. That's Oversight 2025.
So the CFPB and the FTC, of course, are not the only agencies that conduct investigations relating to payments companies and others, fintechs, banks, credit unions, and so on. The Department of Justice is very active. Go to the next slide, please. There's been a lot of talk about DOJ's sort of they're out of FCPA investigations, they're back in it, and where that ends up, we'll see. But I can tell you from this policy memo that was announced by Matthew Galeotti, who's the head of the criminal division at the moment. He made clear that consumer fraud enforcement is still going strong, as well as procurement fraud, healthcare fraud, money laundering, and sanctions evasions. But if you see that first quote, that fraud perpetrated against Americans as individuals, as taxpayers, and as recipients of government services are core to this focus, the focus being economic security as national security. The millions of Americans are victimized by fraudsters every day, some losing their hard-earned life savings, and these schemes harm the public and weaken the integrity of our markets. This is a clear indication that the Department of Justice is going to be focusing on these types of cases. And so, consumer fraud, it's not just, like the mom and pop scams that are going to be going after consumers that they're going to be going after. If you are involved in the scam in any way, if you are a bank that is helping to facilitate the fraud, if you're a fintech, a payments processor, an ISO, anything like that, that you are conspiring with the fraud scheme, you're at risk as long with the underlying bad merchants. The DOJ doesn't see it any differently. If you're conspiring with the bad merchants and you yourself are a bad actor, and they're going to prosecute you. There is going to be a greater focus on corporate self-disclosure, where you can actually walk away with a declination if you come clean in the first instance, and you remediate and cooperate and so on. And they're going to try to speed up their investigations much more so than they have done in the past. Move on to the next slide. One area, however, that is taking a back seat in this Department of Justice is its approach to digital assets. So unlike with consumer fraud or procurement fraud, and Chris is going to talk more about this and the SEC's approach to digital assets and other aspects of it later. But in a memo in April, Todd Blanche is a deputy attorney general, so he's a number 2 person within DOJ under Pam Bondi, released a memo called Ending Regulation by Prosecution. Now that title kind of says it all, doesn't it? And so that memo says that they're no longer going to be charging the digital asset industry with violations of Section 1960, which is the unlicensed money transmission statute, or the BSA or a couple of other statutes, unless there's proof of willful violation, meaning that you knew what you were doing was a crime and was wrong and that you did it anyway. They're going to focus on fraud and scams targeting investors. Again, here's a focus on individuals, much like the consumer fraud stuff I was talking about in the last slide. They're going to focus on the use of crypto and terrorism and fentanyl and trafficking, fentanyl trafficking cartels. Again, a big focus of this administration. The memo says that platforms such as exchanges, mixers, and wallets will not be responsible for users' actions unless they're criminally complicit. Chris and I have been following the Roman Storm case and the Tornado Cash, which is scheduled for trial, I think, later this month, pretty soon, Chris. I think it's in July of this year. So we'll find out. But DOJ, it's interesting that DOJ is going ahead with that prosecution in light of this memo. So, it's a message that despite the fact that they say they're going to be, taking their foot off the gas a little bit, you still got to be careful because there are still prosecutions like the Tornado Cash one that's ongoing. They're not going to be, for the most part, there are some exceptions, but they're really not going to be charging crimes based on whether or not tokens are securities or commodities. They disbanded the National Cryptocurrency Enforcement Team, which was announced a big fanfare to the Biden administration. That's gone. And they have shifting resources to immigration and procurement fraud. Obviously, like I said, those were big priorities of the administration. And DOJ is joining the working group that's going to help shape crypto policy. So, they're going to be a part of that effort. But again, based on what we've seen, there's a focus on innovation and promoting industry rather than slowing it down through regulation or increased enforcement. Go to the next slide. So we talked about industry spotlights. I'm going to focus on that payments, and Chris is going to get into cryptocurrency. Could you go to the next slide? Yeah, so the paddle case that the FTC brought is an interesting one because it really, for the first time, it tackled that merchant of record issue. So in this case, we all know that payments companies are potentially liable for providing their services to a merchant when the payments company knew or should have known that the merchant basically was involved in fraud, was charging or debiting consumer accounts without authorization, or was illegally obtaining their payment information. But what was going on with Paddle was it, so like I said, it's a UK-based payment processor, and it was processing accounts or processing transactions for tech support, deceptive tech support schemes. But what it was doing was it was purporting to act as a merchant of record on behalf of all of its sub-merchants, all of its tech support schemes. Because it was doing that, it didn't register with the card brands as a PayFac. And as a PayFac, as a registered PayFac, it would have been obligated to do sufficient underwriting and onboarding and ongoing risk monitoring. But it didn't do that either. And so the question was, well, is it truly a merchant of record or not? I mean, Paddle says it was. The FTC ultimately said that it wasn't. And the FTC focused on numerous facts, such as Paddle did not advertise or otherwise market its products. It didn't offer any technical support. It didn't set the price or the refund terms or the other terms of the sale. It never took possession of any of its merchants' products. Now, Paddle had argued that it temporarily took possession through like a flash title, that as soon as a consumer bought the product, Paddle would immediately take title of the product and then sell it to the consumer. But the FTC wasn't buying that argument. For among the other reasons I stated, the Paddle's contractual terms frequently refer to its role as a payment and billing solution. The products were sold to consumers under the merchants' names, not Paddle's. And interestingly, Paddle did not book the full value of the product sales as its own revenue, and only booked the processing fees that it generated as revenue. So for all those reasons and others that are referred to in the complaint, the FTC said, no, you're actually not the merchant of record. You should have registered as a PayFac. You didn't, do any of the ongoing monitoring, and you knew that these merchants were engaged in deceptive conduct. And so, you're going to be liable under the FTC Act, as well as, by the way, under the TSR, Jonathan mentioned the telemarketing sales rule, as well as ROSCA. It's interesting because on the one hand, Paddle was saying, well, the FTC said, well, you're not the merchant of record, so you should have registered as a PayFac. On the other hand, it said that Paddle, you are liable under ROSCA because effectively you were standing in the shoes of the merchant. So, you're kind of the merchant of record in a way, and you were standing in the shoes of the merchant. And so you were actually responsible for the merchants not having clear and conspicuous disclosure of all material terms before obtaining consumers' billing information and obtaining consumers' expressed informed consent to their offer before billing. So, the FTC's position was, you're not just a neutral conduit here, you're a central player in the transaction. So it's an interesting approach by the FTC. It's certainly an aggressive approach, and just proof, like I said earlier, that the FTC is still very active, including in the payment space. With that, Chris, I think you can take us into crypto.
Sure. So now let's shift gears and talk about cryptocurrency, and an area where change in regulatory tone and policy has been especially dramatic. Jonathan, you can change the slide. So at a high level, it's pretty clear that the new administration is leaning hard into a deregulatory posture. The stated goals are sweeping: reduce regulatory burdens, promote adoption, and yes, and I quote, make the United States the crypto capital of the planet. And this is not just rhetoric. We are seeing executive orders, high-level appointments, agency directives, all aligned with this mission. Even Trump's meme coins are becoming a part of this narrative, kind of underscoring how both political and cultural forces are kind of converging around digital assets at the current moment. And just as an example, Trump's executive order on digital assets, which I'll talk about more in the next slide, calls for the end of Operation Choke 2.0, which is, I might kind of reference this earlier, but it's kind of an industry coined term referencing the coordinated regulatory pressure on crypto firms. That's where the 2.0 comes in, through banking access restrictions. So specifically trying to break down the barriers that the past administration and agencies within the past administration have kind of placed on digital assets and companies trying to work in that sector. You can switch to the next slide. So let's look at the digital assets executive order. So first, it revokes previous orders and guidance, like a slew of them, effectively kind of wiping the regulatory slate clean. It also sets up a new interagency working group to design future federal frameworks for digital assets. At the same time, Congress is also, they're working on bills to effectively kind of tackle the same issues, but through statute rather than through the executive branch. Another kind of interesting tidbit from the executive order is just a complete rejection of central bank digital currencies. If you don't know what a CBDC is, it's essentially a cryptocurrency, but it would act as, at least in the case of the US, as the dollar, and would be run from the Federal Reserve, an official US issued cryptocurrency essentially. And Trump has made it absolutely clear that in no circumstances will he allow a central bank digital currency. But just kind of more broadly, the order reflects a fundamental change in how the federal government is engaging with cryptocurrency technology. It's prioritizing innovation, reducing regulatory burden, strengthening the United States' kind of competitive edge in this sector. Those are the stated goals. That is what the ultimate aim is. And of course, this is a very stark contrast to the Biden administration's approach, which was much more careful, much more about studying potential risks to consumers, not necessarily being completely against it, but much more of a let's wait and see and study and move forward slowly, piecemeal at a time. Whereas this approach is more, we're opening the gates and we're going to see what works and what doesn't work and figure things out as we go. You can switch. So what is the result here? Well, we're seeing kind of a crypto migration. So the consequence of the friendlier US posture is that a lot of companies that moved out of the US or formed somewhere else because of the US's regulatory environment, their more hostile regulatory environment, especially on the SEC side, because of that change, companies are moving in. And I personally received, many questions from these foreign-based companies saying, hey, we're looking into moving to the US. What do we need to know? What regulations are, applicable to us? And so that is happening. And what a lot of these companies need to keep in mind is that while, yes, there is a deregulatory kind of posture, that doesn't mean there are no regulations, particularly for money transmission, are still incredibly significant. The anti-money laundering rules, sanctions compliance, and even just kind of more basic consumer protection regimes at the state level or the federal level, those all still exist and can apply to your business depending on the structure of your services. So in other words, the welcome mat is out, but the rules still matter. Next slide. So let's look at the SEC a bit more closely. We're seeing a pretty significant pivot, and the kind of reset that's happening here is real. So under Commissioner Pierce, the agency has stood down a number of enforcement actions and have rescinded previous crypto guidances and proposed rules. And just to give a couple of examples, there was this revised Rule 3B16, and that would have expanded the definition of an exchange to capture decentralized finance or DeFi platforms, which are pretty complicated to really describe and get into, but is based on kind of Web 3.0 and cryptocurrencies to kind of create a organization or platform that's kind of not your centralized like bank type lending platform. And this revision would have tried to capture those kind of new technological DeFi platforms under the exchange definition, which would have been swept in potentially these DeFi protocols under the securities rules for exchanges. But this rule was the revision to the rule was withdrawn. So that's just not a thing anymore. The SEC also rescinded the proposed safeguarding advisory client asset rule that would have expanded the existing custody rules under the Investment Advisors Act to crypto. And just as importantly, the agency has like closed or dismissed several high-profile enforcement actions involving exchanges or staking providers. We're not going to name or list them, but these have been pretty significant and big cases that the SEC was pursuing for years, and those have either been paused or just settled and stopped. And the reason behind this, the stated reason behind this, is so that the SEC can develop a more consistent and transparent framework. There have been many press releases that basically stated that the SEC does not want to create a regulatory framework through enforcement. They want to create a framework through guidance and dialogue with the industry. But that doesn't mean enforcement is completely over. It's just becoming more predictable. So we're seeing an effort to separate bad actors from good faith participants in a nutshell. Next slide. So the SEC isn't just like at the chopping block, removing existing proposed rules or existing rules or just rescinding guidance. They're also issuing new guidance and clarifying, just for a couple of examples, that staking and crypto mining and stablecoin activity, when properly structured, are not securities transactions. There are important caveats, of course. For stablecoins, for example, the SEC's guidance only applies to stablecoins that are pegged 1-to-1 with the US dollar and are fully backed by low risk and liquid reserves. Further, such reserves must be segregated and they can't be pledged or rehypothecated. Yeah, that's a tongue twister. So even though all of these guidance documents look like it's just, oh, nothing's a security, there are no rules, the SEC isn't in the space anymore, that's not really the case. And if you read through each of these staff statements, there are important caveats that any company kind of looking to get into this space will need to be aware of to kind of remain on the right side of these interpretations of existing law. One that's actually really fun. Meme coins are getting attention. The SEC issued a staff statement stating that meme coins were not considered securities transactions, and they were likening them to trading cards and collectibles rather than financial instruments. And for those that aren't familiar, a meme coin is a type of crypto token. It's inspired by like an internet meme or a celebrity, fictional character, and so on. And it's for entertainment or community participation type purposes, and purchased usually for like speculation or just pure entertainment. But the tokens themselves don't really have much use otherwise, no core functionality, which is kind of a vague definition, but that's the one we have. And the SEC has said that those will not be treated as securities. But again, the SEC has emphasized that you can't just slap meme coin on a security and call it a day. The SEC has emphasized that simply branding something a meme coin won't let issuers evade the securities laws. If a token functions like a security, then it's still going to be treated like a security regardless of label. So ultimately, these staff statements, while not binding law, provide really useful clarity for firms trying to kind of build compliant products. But you do have to read through and understand them to ensure that you're kind of on the right side of the interpretation. Next slide. So now let's look at banking. The banking regulators, the OCC, FDIC, and the Fed have each walked back prior restrictions on banks engaging in crypto activities. So the new interpretive letters now allow for custody services, stablecoin activity, and even direct asset purchases, provided that the banks implement robust risk management. Probably most notably, the prior approval requirements for a lot of these activities are gone, which had previously been a kind of a high bar for any bank that wanted to become involved in any of these activities, as they would have to, both apply and then get approval to engage and kind of prove that they have the capability to do so. So of course, this opens the doors for banks for quick entry into this market segment, especially where fintech partnerships can help supply kind of the needed tech stack. Next slide. So how does this all kind of come together? We're seeing this strong effort to reverse the kind of so-called debanking of crypto firms. After 2023, many banks dropped crypto clients due to the perceived reputational risk, and industry labeled it Operation Choke Point 2.0. Today, the regulators are pulling back those pressures. So as a result, banks are re-engaging, exploring tokenized deposits, custody, and other services, and working with fintechs to kind of help lead the way on a lot of those kind of projects. Next slide. But there are still expectations. There are still regulatory expectations if you are a bank looking to engage in crypto activities. So what can you expect then? Well, regulators will expect crypto activities to be fully integrated into the kind of enterprise-wide risk programs, not treated as side projects. For example, crypto-related risks should be reflected in the bank's risk appetite statement, and risk committees should oversee these activities just like lending or payments. They also expect institutions to build their own expertise, not just outsource everything to vendors. And they're watching this closely. Crypto is still considered novel, so banks can still expect enhanced scrutiny during examinations, particularly around governance or audit trails and board oversight. We are expecting new joint guidance to provide more clarity. Until then, banks will be held to kind of the existing risk management and compliance standards, but now just kind of being applied to cryptocurrency. Next slide. And then, of course, we have, Capitol Hill, which could completely change the game when it comes to crypto regulation. There have been a number of important bills making advancements. I'll discuss two of them. The Genius Act has passed the Senate already, and that bill focuses exclusively on stablecoin. It would create a uniform federal standard for the issuance, custody, and reserve requirements for stablecoin. I mean, really like cutting edge, leading the field type of bill. And then you have the Clarity Act, which is also advancing in the House, and it aims to kind of define digital assets and regulate digital assets and their markets more comprehensively. This would include clear definitions, and allocating kind of the regulatory authority between the SEC and the CFTC. If passed, these bills would fundamentally reshape how crypto is regulated at the federal level, and in some cases, how state level can regulate or cannot regulate cryptocurrency activities. Next slide. So as we wrap up, I wanted to highlight the big picture, right? We're seeing a kind of a fundamental shift in how the United States approaches crypto regulation. Federal agencies from the SEC to the OCC and DOJ are moving away from a reliance on enforcement and towards a more flexible and purportedly more clear policy framework. For market participants, that's very encouraging, but we're still at a crossroads. The rules are evolving and compliance remains complicated. So businesses still kind of need to prioritize robust risk management. This is a fast-moving environment, and staying informed and proactive are still going to be critical. And that, next question? Questions, if we have time.
Yeah, Chris, I see that we have like maybe a few questions here. I think one question in particular that caught my attention, and those that we haven't gotten to, we'll get to, is a question here. What should companies be doing right now if they're seeking investment or preparing for a potential exit, given the new regulatory structure? And I think that what they're referring to is probably some flux. And obviously that's what we've been talking about. And I think that's a great question. It's something we're seeing a lot of in the current environment. And I think the key is that diligence goes beyond just the checklist, particularly understanding not just what the law is, but where it's headed. And oftentimes, smart investors want to know that there's no hidden state issues, particularly like licensing issues, change of control, legacy issues around the product, but then, also understanding where the market might be given what the regulatory environment had been versus what it will be. So there's certainly no shortage of topics to go into a diligence for potential investors in the financial services space. That would be true for traditional areas as well as also the digital payments and crypto.
Yep, and just to repeat the CLE code, it is Oversight 2025. Oversight 2025.
Hey, Jonathan, before we go, I did one question for you is what do you think the legal risks are for AI? We hear a lot about AI. What are your thoughts on that and with respect to consumer finance?
Yeah, I think that by and large, the same risks that have always been there. The risks are mostly old laws applied in new ways. And whether or not they're at the top of the CFPB or an FTC's prioritization list, I think is secondary to the reality that whether it's the Fair Credit Reporting Act, Equal Credit Opportunity Act, GLBA privacy rules and safeguards, and then general UDAP concepts and anything else that may be relevant to what the AI is being used for, if there's an error or issue caused by the technology, that's still going to be, by and large, an issue that somebody's going to pin on or attempt to pin on the company. And black box understandings by the legal and compliance departments really wouldn't suffice in the development and deployment of those tools. So I think right now the best advice is for folks to recognize that the tools are certainly being used, but that they present the same risks as using any other tool. They have to be understood and worked through like anything else.
That's right. All right.
Well, with that, I'd like to thank my colleagues, Chris Boone and Michael Bresnick, certainly our staff and team for helping us put this together, and for you for attending today. Again, if there's any questions, please feel free to reach out to us, and we'll be in touch with you with materials in short order, as well as also you can download this presentation and others on our website at venable.com. Thank you.